to be recorded. So we'll be sending out the PDF as well as the recording of the webinar. The idea there is for you obviously to review the presentation. You might come up with more questions. You'll have my contact details in here, so you'll be able to contact me. There will be a section where I'll be answering questions anyway, if there are any questions, if I haven't covered within the presentation. Okay, so let's get started. So let's kick it off. How many of you feel overwhelmed by the markets at the moment, and obviously also coming to analyzing the market and shares? I think a lot of you will be in that situation, number one. And number two, how many of you would like to be in a situation where you simplify the markets? So it's easy to understand, it's not so complicated, you know which way the market's going, etc. So that is the gist of our presentation today. The topic is obviously technical analysis does not need to be complicated, and there's a subtitle there is no holy grail. And I've been involved in the market since 1988. Those of you that do know me, I see quite a few that are on this presentation are regulars. You know that my background is such, I am a technical analyst, but over the years I've learned that there is no holy grail. The holy grail refers to the cup that Jesus Christ drank out of, and obviously is supposed to be for everlasting life and all that kind of stuff, but it's something that no one has ever found. That's the holy grail. But here's a look, and I can't remember where I got the quotes from. The holy grail of trading is that there is no holy grail of trading. You know, we'll talk about technical indicators a bit later, but I've learned that there are thousands and thousands of technical indicators, which are just mathematical formula that people come up with. Yes, some of them work well, and some of them don't work well. Some of them are not consistent. But I've learned over the years that the holy grail is that there is no holy grail. If I had the one single technical indicator that will tell me when to buy and when to sell all the time, I won't be sitting here. I'll be sitting on some paradise island sipping caipirinhas. Okay, so I think that is the overall context that we're going to talk about today. But you know, the current position for a lot of people, obviously, as I mentioned just now, is that you know, some of us might be losing money. Some feel that we're misreading the markets. Some of us feel that you know, obviously we're on the wrong side of the market, first of all. That's why we're losing market, especially with the derivatives, single stock futures and CFDs, because of the leveraged nature. Obviously, you'll be feeling the pain. So this is where I think it all starts. If I had to highlight it for you, very simplified, bring my spotlight up. There's a lot of uncertainty in the market, either from a political point of view or from obviously economic point of view. You know, we just had the budget speech and things like that. There's a lot of things happening with SARS at the moment and Provident Gordon, creating more uncertainty. Obviously, the rand and things like that also being knocked. So the uncertainty is creating the volatility, and that volatility obviously has caused the market to a certain extent to decline. Obviously, the market doesn't like uncertainty and volatility, and we sell out and we'd rather sit on the sidelines, and hence the market decline. Yes, there's an element where the market is overvalued. If I had to bring in some fundamentals into it, there are pockets of overvaluation. The market's generally, I would say, fair value. But this has all led to confusion. So yes, last week we spoke about value traps. So especially if you look at some of the stocks in the resource sector, I mentioned Azure and I mentioned Exxaro. We're seeing what's happening with the financial sector, especially the banks, all that kind of stuff. But at least especially from a trading point of view and the technical analyst or the chartist, trying to look for the holy grail and bringing in more and more technical indicators and getting to a stage where the graph looks like spaghetti, and it's complicating things. So that's what I say is the situation for a lot of people right now. So as I mentioned last week, what is working right now, just understand this is a normal trading cycle. It's a correction within a bull market, but in the sense it is also a wake-up call to the risks, especially the stocks in your portfolio. You might be exposed to undue risk. Some of the stocks have got no future prospects, and obviously the whole idea is that you're going to make adjustments accordingly. So those are the current realities for a lot of traders. What's our ideal situation to be in? Obviously, you want to be making money. You want to be in a situation where you know, it depends on what style. If you're a swing trader or position trader, you're still buying and selling and taking advantage of the magic of compounding. So you got more money to buy more shares, and so your portfolio grows. But also, bottom line, where you're avoiding taking positions against the trend, obviously being on the wrong side of the market. So the other idea is that peace of mind. And I always believe that, it's not so much about making money in the markets. My goal as a trader is to be a consistently profitable trader. And obviously the money will follow from that. So I think that's where a lot of us want to be. So how do we get there? What am I proposing today? And the whole idea is that there's two approaches to the market. Yes, we're talking about fundamental analysis and technical analysis. Those are the two main approaches. We talk about the three questions: what must I buy? When must I buy? When must I sell? The what to buy is the fundamental analysis. How good will this company be as a generator of future profits or earnings? So when we look at fundamentals, we can look at the big picture. How does the company operate within the economy? And all the factors or macro factors that can affect that company, be it the growth in the economy or contraction, interest rates, inflation, labor. There's a whole lot of things. We talk about micro fundamentals. We talk more specifically about the nature of the business, but more specifically the financial statements of the company. I still refer to the old way of looking at it, to the old balance sheet, the income statement, and the cash flow statements. From that, we get a lot of ratios to help us look at growth. Number one is the growth of the company, and secondly, obviously, the health of the company, that kind of stuff. But the focus today is more on the technical analysis. It answers the other two questions: when to buy and when to sell. So the critical success factor here is getting my timing right. I believe it's more important is to be on the right side of the market, and that's where we'll be focused on. We have fundamental analysis. There are a lot of factors involved. Technical analysis, there's only two things we're looking at: price and volume. So if I were to give you a definition of what I think is technical analysis, is everything we know about the fundamentals of the company. Remember how people feel about future prospects, about future earnings, and that's reflected, number one, in the company's share price, and number two, the volume, the number of shares traded. And when I say volume, is people's commitment to price. So I want to be buying as many shares as I can, and that's what I mean by commitment to price. And price and volume obviously will be dictated to by supply and demand. We as a group of investors or traders optimistic about future prospects will buy into the share, and obviously you'll lift the share price up. That's what we call demand. It gets to a stage where from a fundamental point of view might be overvalued, and even from a technical point of view might be overbought. So now we start selling, there's oversupply, pushes the price down. But anyway, that supply and demand will create trends. Your goal as a technical analyst is to identify those trends, number one, and number two is to look for patterns, because patterns get repeated. So that is in a nutshell what I call technical analysis. But what's also very important, it's all very well looking at charts and things like that, but who are creating those charts, who's creating those patterns? Bottom line, I believe it's people, and that's market psychology. And there's something you always have to take in consideration: human emotion. So when the market's moving up, obviously we're talking about greed. When the market's falling, we talk about fear. So market sentiment, how the market feels about the market, also very important. So yes, this is very quickly the first stage. Things are getting better. This is after the market has dropped. And yes, we're taking a bit of a contrarian view. When everybody else is selling, you want to be buying, and when everybody else is buying, you want to be selling. It fits in what Warren Buffett used to say: be greedy when everybody else is fearful, and be fearful when everybody else is greedy. So yes, the first phase, the clever money starts getting in. That's the first stage. The second stage, more people acknowledge that the improvement actually is underway. And the top of the market, and I always joke, is this is where the hairdressers get in, and things are going through the roof. The general sentiment is buy a share today, buy a Porsche tomorrow. You can't go wrong. Take out a second bond, etc. And just at that time, that's when things are, where the clever money starts saying, well, things are not going to be like this forever, and we won't stay so rosy. They start setting out. Stop losses all gets triggered. The second phase is where the people who got in a bit late, they start acknowledging, yeah, let me get out, let me break even now, and I'll wait and see. And the third stage is where things are only going to get worse. This is where the poor hairdresser can't handle the pain anymore, and she sells out. Okay, so the point of this slide is just to highlight, and this is just of the presentation, my proposal today is to keep it simple, be aware of the psychology behind it. There's no, you don't have to be a rocket scientist to understand this stuff. Just some basic ideas and techniques will help you understand the market better. Okay, so here's a quote from Jim Rogers. Yes, he's a legendary investor, but it can also apply to technicals and trading. Markets often rise higher than you think is possible and fall lower than you can possibly imagine. It's the same thing when we talk about being overbought and oversold. The market can be overbought, trading at very high levels, longer than you can stay solvent. That's always the joke we have in the market. Okay, so just be aware of that. So let's get into the nitty-gritties. What is the approach I'm suggesting, and what will this do for you? What are the benefits? So I like to keep it simple. I look at three broad strategies when I'm looking at trading. First of all, the question I'm asking myself, is the market trending or is the market trendless? Trendless is market moving sideways. Secondly, is the market overbought or is it oversold? And thirdly, is this particular share or market segment or index outperforming or underperforming the market? And then from that, I build on everything. But just understand, we're laying a foundation. And the first part of this presentation today, I want to look at trends and cycles and using a tool as a moving averages as a tool to help me establish the trends. And that's the whole idea, is to keep in mind that the trend's your friend. I know it's an old cliche, but if we're on the right side of the market and we're trading with the trend, we won't be losing money. So how do we do that? There's three things you need to know. First question you always ask yourself, what kind of market are we in? Secondly, when I say what kind of market are we in, is the market moving sideways, or is the market moving up, or is the market moving down? And when I say up or down, that's trending. The three cycles you get in the market. We talk about a primary cycle, a secondary cycle, and obviously the daily fluctuations. The primary cycle is what we call the bull and the bear. Lasts from a few months to a few years. Okay. Definition of a bull market. If I bring my little cursor in again. Whoops, let me bring it out. I lost it. Okay. Looks like I've lost it. Whoops, let me go back. I hope you guys are still with me. Everything's fine. I'm freezing from time to time. Okay. I hope that's not happening to everybody. Keith, I appreciate that feedback. Guys, maybe I must just switch off the camera. So maybe you can spend some more bandwidth there. But you know what I look like. Okay, you know what my home study looks like now too. Okay. Okay, so I hope that's make things a bit better. So the idea is of a bull market, a definition of a bull market is higher highs, if you can see my cursor there, and higher lows. And that's over from a few months to a few years. So the trade is long term. Definition of a bear market is lower highs, lower lows. A bear market is slightly shorter than a bull market. I always say it takes longer to walk up the stairs. Bear markets is where you jump out the window much faster. Okay, so and coming back to what I said just now, what we're seeing at the moment in the markets, it's normal. We need to have a bull market and a bear market, bring things back to more realistic levels, bring valuations back to more realistic levels. Okay, within that long-term primary bull and bear trend, we have what they call corrections and rallies. So within the bull trend, we have these little pullbacks. If I can see my cursor over here, those are called corrections. Within the bull market and the bear market, when the market's falling, these little moves against the falling market is what we call rallies. Okay. And then obviously the third scenario is what we call daily fluctuations or daily moves, minor moves. Today's close compared to yesterday's close. And this is where a lot of us fall into the trap, even as short-term traders. We're looking at the trend now, and I know a lot of us use, for example, Swordfish, which just shows you live prices tick by tick, and we only show the day's movement. Your goal is, even as a short-term trader, is to establish the long-term trend, or we're in a bull market or bear market, and from there you can chunk down. And this is where a lot of us are getting it wrong. Okay, and this is where we want to focus on today. By the way, we mentioned just now in a bull market, this is greed. And this is fear when the market's falling. This is a demand exceeding supply in a bull market, and oversupply of supplies overcoming demand in a falling market. More buyers than sellers and more sellers than buyers, if you look at it that way. Remember, the psychology behind it is important. In a sideways market, now this is important, a third of the time the market's moving sideways. And this is the market you should be looking for. And we're not going to go into too much detail. We're not going to go into detail today. Obviously, other webinars. This is one of the strategies you want to use, what they call breakout trading. You want to break out of a sideways trade, sideways market, either up or down, and take advantage of that move. But in the sideways market, this is where the bulls and the bears, the buyers and the sellers, are having a bit of a tug of war. We're waiting for new information. If it's positive, bullish, we break up. If it's negative, bearish, we break down. Okay. So, as I mentioned just now, don't look at the minor trend. Don't look at today's move compared to yesterday's move. Your main goal is to look at the long-term trend. So yeah, this shows you and I suggest, look at a weekly chart. Okay, establish the trend there, and this is on the highlight for you. You can see the long-term trend is up, number one. Number two, it also highlights that our so-called crashes. This is back in 1987. That was a 27% drop. By the way, this is a log scale, so it's adjusting it for percentage movement. That was the Asian crisis. That was 45% drop. And more recently, the financial crisis, the subprime crisis in the States, that was a 46% drop. But usually it takes the market about 2 years to recover, okay? But the long-term trend is always up, okay? So what's important, look at the long-term trend, a weekly chart, and then look at the daily chart. You want to be trading in the direction, both markets, both time frames, and this is what they call time frame analysis, must be trading in the same direction, okay? So that's the first step we want to look at. Second thing, and I bring in some of the terminology now, we talk about support and resistance. In a rising market, as soon as we break out above a previous resistance level, okay, that level, that price there breaks above a previous resistance level, we've got confirmation that the price is going up. We need a ceiling or resistance. This is where more sellers come to the market. Price falls back a bit. We meet the area of support. More buyers come to the market. Again, as we overcome the supply, overcome the buyers, the sellers, the trend goes on. But what's important to analyze or to realize is the previous resistance can be a support level. So now you start anticipating how far will the market pull back in the rising market. In a falling market, how far will the market rally? So a previous support level, previous low will be the next resistance. How far will the market rally up? So this helps us to highlight turning points in the market. And this is what you want to use as a tool. So we're going to talk about cycle analysis just now, and we build up on this. These are the foundation, basic building blocks that helps you get on the right side of the market. And then the third tool you like to use is what we call trend lines. And the trend line is a very simple tool. You're going to find a prominent low, extrapolate to a second point, and ideally a third point. And from there, extrapolate into the future. The more times it touches, the more reliable that trend line is. The longer it takes, the more reliable it is. But as the word implies, should the share price fall below or break out below the trend line, then it's a trigger that trend is changing. You might also want to have some rules in place that they might want to close down at least 3% below the trend line. That gives you confirmation, because sometimes you do get false signals. So those are some of the things you must be aware of. In a falling market, you want to connect all the resistance levels or the highs. As long as the share price stays below that, the trend is down. How would I know a change in trend? When we break out and close above that resistance trend line. And from here, we can say we start making higher highs, higher lows. Then we've got a cycle analysis, and we've got more confirmation. In a sideways market, very important that you put that support and resistance levels in. Remember, trend lines act as triggers. Okay. And the third tool, or the fourth tool rather, you want to use is what we call chart patterns. In these two groups, continuation patterns and reversal chart patterns. I like to use more the continuation patterns. In the reversal charts, we have what they call double tops and double bottoms. They're quite common. You find a double top. I always think of McDonald's arches. Trend reversal down. McDonald's bad for you. W is a wimpy. Trend reversal up. Wimpy is good for you. Doesn't matter which way the market's going. Remember I spoke just now about price and volume. Very important on the breakout below that previous support level. Okay, I want to see increased volume. So I want to see panic selling. That gives me that confirmation. When it breaks up above that previous support level on the double bottom, I want to see increased volume. I want to see panic buying or people's commitment to price. Okay. You get rising wedges and a falling wedge. You can see the two converging trend lines. It's like a pressure building up, and when the pressure is released, it usually breaks out against the trend. So if you're not watching that, you can lose a lot of money very, very quickly. But if you're not going to trade it, rather stay out the market. And you got a broadening formation to diverging trend lines, and this is where human emotion, greed and fear, has got out of control. Excessive bullishness, excessive bearishness, excessive bullishness, and then panic selling. Okay, again, if you're not trading this, rather stay out the market. The most popular and the most effective reversal chart patterns you'll use is what they call head and shoulders formations. So this is the top of formation. Bottom of formation, we call it the inverse head and shoulders. There's your left shoulder, your head, and in your right shoulder. What's important is to connect the two lows together, two support levels. That's what they call the neckline. Either point up, point down, doesn't matter. What you do is you act only when it triggers, when it breaks out and closes below that trend line. So what's useful about this, and that's why it's so powerful, is you can measure from the top of the head to that neckline, and that same distance projects from the breakout down. You've got a high probability of knowing where the share price is going. And this is the secret, I believe, to trading successfully. Number one, if I know direction, in this situation, I know the trend is reversing down, I know the direction. Secondly, I know where the market's going. If I've got a sell signal to go short, I'm taking advantage of falling prices, I sell at 10 Rand, and I've got a high probability, 80% probability, of buying back at 5 Rand to make a 5 Rand or 50%, would you go for it? And this is what you're talking about. So this is what brings the odds in your favor. High probability trading by using tools like this. So head and shoulders, trend reversal down. Inverse head and shoulders, same thing. Remember, on both scenarios, increased volumes gives you that confirmation, change in trend. The ones I find most powerful are continuation chart patterns. The one I like the most is what they call a rectangle, when the market's moving sideways. Remember, this can be also a triple top. It depends which way it breaks down. If it comes from the bottom, moves sideways, then breaks down, or it is a complex triple top, then it's a reversal pattern. That's why it's important to use those trend lines as a trigger. Okay. What's useful about a rectangle formation, I can measure the distance between the support and resistance level. Let's say that's 5 Rand, that's 10 Rand. So we get the difference is 5 Rand. If it breaks up or breaks down, I know my target price is 5 Rand. And that's where it's powerful. Okay, so it eliminates a lot of thumb sucking. It gives me a bit of a target to go for, especially if that target price coincides with a previous high and low or a retracement level. Whatever the case might be, a moving average, that gives you more confidence in that trade. You also get triangles. This is what they call a symmetrical triangle. Some it has to touch at least 5 times before breaking out. Symmetrical, both converging triangles, trend lines rather, are the same. Again, you can use this as a measuring tool, anticipate where the market's going. Obviously, symmetrical triangles, a bit more longer term. Shorter versions, what they call pennants and flags, but the sentiment's the same. We move from the bottom, we come from the bottom, move sideways, and then continue on our original path. That's where the chart pattern name comes from. Two very powerful patterns I like to use a lot, what they call a flat top or ascending triangle. So we're hitting this area of resistance, a lot of sellers, usually at a round number, like a 10 Rand, for example, and then eventually the buyers overcome it. And what I like about this pattern, especially if it coincides with a 52-week high, okay, we break it above a previous high and we've got blue sky potential. In other words, there's no sellers, there's no more sellers, we're just buyers. Demand is overcoming supply, this is where the market flies. And this is where it's powerful. So high probability trade, that's what I call a ascending triangle. The opposite would be called a descending triangle. We've got an area of support, and eventually the sellers overcome the buyers, and we have the trend continuing falling down. So you want to go short in that scenario. Okay, so guys, that is, I believe, the foundation of your technical analysis. Those 4 tools. If I can understand, first of all, is the market trending or is it sideways? Okay. Secondly, where's the support and resistance levels? Where's my trend lines? Where's the support and resistance levels there? From that, I can build on that. And to keep it simple, as I say, you can use what they call overbought, oversold. This is where you bring in your oscillators. Now, just be careful with oscillators. When I talk about oscillators, your traditional indicators, RSI, stochastic, those kind of things, they work better in a sideways trendless market. Okay. If you want to trade trending markets, moving averages are powerful for that. And you'll see in the next slide we talk about it. Okay. But I believe after price action, well, just looking at that price action, we talk about price action by looking at line charts and go one step further bar chart and one step further candlesticks. That's what I'm talking about, and all those different patterns we just spoke about. What's important now is to bring in volume confirmation, confirming a breakout and things like that. But also from there, I like to use an indicator called moving average convergence divergence. Why? Because it works well in both markets. It works well in the trending market. It works well in the sideways trendless market, number one. Secondly, it highlights for me seriously overbought and oversold levels. And thirdly, obviously, it also highlights for me early warning signals. You can use what I call divergence. This is where the share price might be going up, but the indicator is doing the opposite, diverging. So telling me, watch out, the share might be changing direction. So bullish and bearish divergence, early warning indicators. But also, there's various ways to use it as a buy and sell indicator. I can either use a crossover of the trigger, or I can use a crossover of the zero line. But I'll go into more detail just now. And the third scenario, if I want to go short, take advantage of falling prices, I also want to find a stock that's overbought. I also want to find a stock that's relative to the market is underperforming. If it's really a strong stock, I'm not going to go short a outperforming stock. And this is what I've learned over the years. Your trend, your friend. Okay, so those are the three broad building blocks I would use. So here we go. Moving average crossovers. I've used for years a 50-day. This is your red line here, and a 200-day moving average. I use it mainly to help me establish a trend. You can see there's a crossover there. That's what we call the golden cross. It's good news. Anything above this is positive and means bullish. Okay, if it was vice versa in that scenario over there where it crossed, that short period was bad news. We had a bear market. Okay, it was more like a little correction. Okay, why do we use a 50-day moving and a 200-day moving average? 50-day moving average, remember it relates to a 10-week moving average. A 200-day moving average works out to a 40-week moving average. So most of the time, a 50-day moving average would highlight when the market pulls back and it can act like a support and resistance level. Call it another trend line. The 200-day moving average is extremes. You can see how many times it touches there. So this is good entry levels. Okay, so obviously you can create different templates. I've got it, as I say, a 50-day and a 200-day moving average. I have a 100-day and a 50-day moving average. I have a 10 and a 21-day moving average. Different periods, but the idea is to have the moving average crossovers. Then we start looking at the relationship of the price relative to those moving averages. Look at the slope of the moving averages. All those kind of things help us anticipate where the market's going. You have the example, you can see that the 50-day moving average is a bit of a sideways market here. It's slightly down, but it's still pointing up, where the moving average, the 200-day moving average, is still pointing up. So this is, to me, is still very bullish, although it has pulled back slightly. This was a slight little correction. Okay, so building on that now, this is where we talk about volume confirmation. Volume gets displayed at the bottom of the screen in the form of a histogram. And when you go one step further, is I look at a thing called on-balance volume, which looks at adding the volume when the price goes up and subtracting volume when it goes down. Volume price trend, one step further, we look at percentage movement. The bigger the percentage movement in price, the bigger the volume I put in. What's important, first of all, is that they must agree. So they're both trending up, that's great. If they divergence, I'm getting a bit worried. If the share price is going up and the volume is doing the opposite, well, I'll get worried. Because remember, the main players here in the South African market are institutions, pension funds, unit trust guys, all that kind of stuff. If they're selling out, this is where we talk about volume accumulation. When the price is going up, or volume is going up, it's volume accumulation. When it drops like that, you can see also a big spike there. Remember, for every single point on the graph is a buy and a seller. So someone sold and someone bought. That big volume there, it's not a small private investor. Big institution. So yes, they might have bought at a lower price. You can see what happens in Zen. There's big spikes here, and there the price jumps up. You can see this on the price. It jumped up big time. this highlights a bit of, for you as an investor, some insider trading. You want to take advantage of this. So yeah, you can see the share price is falling, but the volume hasn't really come off. So the institutions haven't really panicked. Okay, this is private investors getting out mainly. Okay, so volume is very, very important. So it's not really complicated, and a lot of people do trade the volume price indicator as a signal to buy and get in and out the market. Okay, and the third thing I like to, as I mentioned just now, was the MACD. It highlights for you anything below the zero line is what we call oversold. More sellers and buyers pushing the price down. When the price goes up, it's overbought. You can see these levels here. We are seriously overbought. Okay. But yeah, we are seriously oversold. Sorry, I'm just going to frog out my throat. Here's an example of what they call bearish divergence. Share price is making new highs. Indicators failing to confirm it. And lo and behold, if you anticipated that as a leading indicator, could take advantage of that falling price there. However, we are now oversold and we're starting to move up. As I say, long term, we're still bullish. Okay. And the third scenario you want to do is what I call rate of strength. I've taken, this is the bets we're looking at, British American Tobacco, relative to the whole market. So yes, I'm looking at a rand edge stock, but you can see the trend here. It's bullish. It's outperforming the market. Okay. So yes, it has pulled back, but it has crossed the average, 10-day moving average again. So this is still showing me strength. I will not short this stock right now. Okay. So that's the gist of my presentation, people. I hope you've learned something. Keep it simple. And those of you know, I've been with PhD 16 years. I've been talking the same talk for 16 years. There's no holy grail. And I know a lot of you guys ask me to write custom formula. I've been using this analysis going on since 1988. Okay, so there's no dark secrets. So, what are the benefits of this? So you might have, you say, I've got other questions. What about other technical analysis? Remember, I've just laid the foundation. It's up to you to build on it. This is how I look at technical analysis. I use a lot of the studies. Fibonacci, he was an Italian mathematician, and a lot of software packages have Fibonacci retracement, fans, arcs, and time theory. I'm also a great believer using Elliott wave theory, but it just shows me that which phase of the market we're in. That's the things that I like to use a lot. If I look at other technical analysis, not so much technical indicators, it's more that analysis. Where's the market going? Where's the support and resistance levels? Some of you might be saying, okay, the markets are so unpredictable. What happens if I get my timing wrong? Okay, what happens if I bought the wrong share? So, yeah, obviously from an investment point of view, diversification is important. But from a trading point of view, there's always two sides of the coin. Risk management, very important that you use a stop loss strategy. And what's nice is technical analysis, your charts, your support and resistance levels would tell you where to put the stops in. And also very, very important, especially when it comes to derivatives trading, money management, position sizing. How much am I going to allocate to each trade? You know, you've got 100,000 Rand. You should never never allocate more than 2% of your capital per trade. So that's all to help you manage. If your fundamentals and technicals don't work, this is your safety belt. Okay. And some of you might have this question, what about fundamental analysis? I've coined the phrase rational analysis. You know, we talk about what to buy, when to buy, and when to sell. I believe in, if I can answer all those questions, I'm betting the odds in my favor. But you know, on our website, PSG Wealth's website, we've got a very, and I've hyperlinked it for you, award-winning research platform. It highlights for you value stocks and growth stocks and things like that. But also, we save you time by scanning the market, number one. Secondly, obviously, giving more analysis on different companies, which enables you to create a watch list of potential winners. Okay, and that's some of you know that I also use a program called VectorVest. I use various programs. If you click on this link anyway, to take you through to a special that's got for PSG. But the idea is VectorVest combines fundamentals and technicals together. Okay, so you can use it for South African database as well as one in other international market. I use it for the American markets. Some of you might have questions like, what technical analysis software programs would I suggest? Obviously, we've got our own Win Professional Plus. This is great for a novice, a beginner. The software is for free. There is a fee for that to keep information up to date, what we call the data share subscription. But it's a great little program. Yes, it is the old program. We're not doing any more development on it, but it's a great tool to get started. Some of you might know also I use a program called MetaStock. I use the download from PDSnet. If you click on that link, it'll take you through to them. They've got the latest version at the moment, which is version 14. I'm still on version 9. I'm perfectly happy with it. And also, you can also click on this link here, Traders Edge. Dave Jackson is the MD of this company. He's still got version 13, by the way. But he also give you some mentoring on how to use the program. He uses Metastock, uses OmniTrader, and I mentioned before VectorVest. Dr. David Paul, good friend of mine also. He brought VectorVest into South Africa. But those are the 3 links you can look at if you haven't got a software program as yet. Remember, from a trading point of view, technical analysis is your number 1 tool. Charting. Okay. And then why I want to use PSG Wealth for your equity research. As I say, we have a broad range of financial products, from equity to all the derivative products. So the whole idea is one login, one platform, which is convenient. The trading platform obviously gives you direct market access, as well as you'll be able to place alerts and stop orders outside trading hours. So it saves you a lot of time. Research platform, as I mentioned before, the Value Investor, all those kind of things are award-winning, and obviously the big time saver. And then lastly, obviously, we've got a technical support team to help you, even just a support team to answer any questions you might have. Okay, so are there any questions? I've gone over a bit more time here. Wow. Quetta, I'm not 100% sure why the market rejects your short positions and accept only your long positions. I'll have to look at it. Come back to you a bit later. Okay. Ken, your question is, please explain again, how does one estimate a target price from a breakout of a sideways triangle formation? Great question, Ken. Let me just reiterate again. You've got a sideways market, so you measure, you've got a support level and the resistance level on that rectangle. You measure the distance between the two of them. So let's say the lower support trend lines at 5 Rand and the upper resistance trend lines at 10 Rand. The difference between the two of them is 5 Rand. So if the price breaks up above resistance, my target price will be 5 Rand from the 10 Rand, which is 15 Rand. And it obviously breaks down through support. If I had 5 Rand, my target price would be going bankrupt. Okay, so that's the idea behind it. Okay, Benjamin, no problem. You can send me the email. Neil, where do I find the notes on the PSG Value and Quality Investor? Not 100% sure, but I can send you my previous webinars, Neil. I think that'll answer some of your questions. Okay. That looks like all the questions. Are there any other questions? Okay, well, we have it. Okay. Which indicator? Here's a question from Ken again. Okay, good. Some more questions. Francois, it's a pleasure. I'm glad you enjoyed it. Ken, which indicator is used to determine strength? Sure. I'm not 100% sure what you mean by strength. RSI, for example, compares a share against its past performance, which is a measure of strength. Relative strength, I'm comparing one data stream to another data stream. If one stock is getting stronger than the other stock, obviously I want to go with that stock, and vice versa. Yeah, Neil, I'll send you the presentations. Neil Volata, ADX. ADX is a great indicator. I use a lot, especially to find. ADX means average directional indicator. It's part of the DMI indicator or directional indicator. ADX, you use it to find sideways markets. So when the ADX is pointing down, we're going into sideways market. When it's pointing up, we're going into trending market. So a great question. Okay. Stuart, I'm glad you found the presentation interesting. What about momentum of trend? Again, Cyril, momentum of trend, if you want to measure the rate of change, if that's what you mean by momentum, you'll use the momentum indicator. And there's also an indicator called rate of change indicator. And as I mentioned in the presentation, there are thousands of indicators out there. and different strategies if you want to look at using oscillators. Just understand there's pros and cons with each indicator, when they work and when they do not work. So I hope that answers your question, Cyril. Okay, let me see other questions coming through here. It looks like a lot of it. Sorry guys, I've gone over time again, but I get so caught up with this, I get excited now to talk a bit longer. Okay. So in conclusion, quickly, there's no holy grail. The basics, I believe, is establishing the trend and looking at the cycles, using support and resistance, or establishing those turning points, and using trend lines. Very basic tool, but very, very effective. Chart patterns also, combine it all together with support and resistance and trend lines. Powerful. I believe all those oscillators we've been talking about are secondary. Past action is my primary indicator. So moving averages is a tool to help you establish support and resistance level, but more importantly, for you to get your trend right. Volume confirmation, very, very important. But as I say, you can build on a volume, oscillators, relative strength. But remember, they are secondary. So the whole thing I want you to remember from this presentation, to make better, well-informed trading decisions, get the trend right. And that'll give you peace of mind. Okay, so what to do next? If you haven't got a trading account with us as yet, open up a trading account. The software I was mentioned just now, the Win Professional Plus, is free. Their subscription is only $169 per month. Please, I'll be sending out the presentation this afternoon, the recording. I'll also be sending a market survey. Please answer that. Give me some feedback. What did you like? What didn't you like? What do you want to see more improvement of? I really appreciate that. And just quickly, lastly, upcoming webinars and seminars, 2 weeks' time in Pretoria. Our first presentation this year in Pretoria. 2 parts to it. We're discussing how to use leverage, how to leverage your local share portfolio, and we'll also be talking about offshore investing. I think that's quite pertinent at the moment. A lot of guys are worried about what's happening here. Is it a good time to take your money offshore? Next week, we're talking about derivatives again, how to use gearing and leverage in your portfolio or trading derivatives. 16th of March, we're talking about, are you worried about tax and estate planning? 30th of March, why you should have exposure to property ETFs. I've got the guys from Grindrod Core Shares come to talk to us again. By the way, the 23rd of March, I'm not here. I'm away on a holiday. It's long Easter weekend, or the weekend before that. So I'm away. April, we're talking about investing offshore. And in the middle of April, we're talking about, are you an investor or trader? And we talk about the pros and cons around that. But guys, thanks a lot. I hope you've enjoyed today. It was nice to actually do this presentation from home, nice and relaxed and convenient. There's my contact details. If you have any questions you might have, obviously I'm not at the office right now, but send me an email and I'm glad to get a hold of you. Okay. And lastly, disclaimer, obviously anything I spoke about today, highlighting any stocks and things like that, it was mainly for educational purposes only. It was not there to solicit any trades from you guys, but obviously I hope you've learned something today and found it useful. Until next week, all the best. Keep well. Bye for now.